Spitznagel, which is a founder of Universal Investment, is issuing one of the starkest warning on Wall Street. Spitznagel, Mark. He predicts you can see a massive euphoric rally, which what we're seeing right now, before devastating 1929 style crash. He calls with the greatest credit bubble in human history and warns that when it bursts, the fallout could be worse than anything we have seen in modern time. Why are we saying that? Listen to me now, believe me later. Okay? Right now, for example, as far as the tariffs are concerned, yes, the U.S. is collecting about $300 billion worth of tariffs, and they're going to do so until the end of the year. At that point, what's going to happen is you're going to have the Supreme Court that's going to decide whether or not that is something that makes sense, right? That meaning that whether or not the tariffs are legal or not. Now, what do you think happens if they say, well, the tariffs are not legal? You got to give the money back. And on top of that, that is going to upset very much the credit markets, the bond markets that relies on those payments to keep up with the amount of debt that the country has, $37 trillion. And that's why we reason that this greatest credit bubble in human history, and warns that when it bursts, the fallout could be worse. Now, when is that going to happen? That is the point. No one knows exactly when, because essentially the flux will go in and then the flux will go out. And that will be huge. So what is Spitznagel really saying? What's his point here? What is he referring to? Well, let me tell you. So basically, what Spitznagel is saying, he's a founder of Universal Investment, by the way, and he's warning against a market trajectory that looks almost like continuation of strong rally and euphoric high. Everybody wants to make money, and then they want to make even more money. He expects market to run further beyond the turning point, which is sometimes called the face-tipping rally. In his view, now is a stage of excessive optimism, when many investors have piled in, pushing valuations very high. 2. Credit bubbles and debt excess. He repeatedly warns of what he sees as the greatest credit bubble in the human history. $37 trillion is a lot of money. Low interest rates over a long period, high leverage, and government debt burden are a key part of the risk. He highlights, when rates rise or when debt servicing costs climb, those excesses become vulnerable. Fed policy intervention and moral hazard. Spitznagel see frequent capital intervention as both fueling the rally and deferring the natural correction, which he argues makes the eventual crash worse. He uses metaphor like forest fire suppression. Trying to put out every small fire makes much more dry fuel accumulate than when something finally ignites, the damage is greater. Number 4, euphoria, overconfidence, and crowd behavior. He points to indicators of investor sentiment reaching extremes. Institution and household heavily exposed to equity sentiment that seems to assume price will keep going up and up and up. 5, prediction of crash worth and recent ones. Spitznagel doesn't just expect a normal correction. He's warning that the fallout could be comparable to the 1929 crash. Remember, we haven't had a stock market crash in a while. When was the last bad one? 2020. But that wasn't really a crash, right? It was tied to COVID. The real last bad one that we have in 2008. That's a long time. That's almost 17 years without something major. So advice for investors, don't over leverage, don't blindly chase the rally. Position so portfolio can survive severe downturns. That is important, and I will tell you that what's important to do, right? What's important to do in these times, what you need to do is you need to make sure that you understand your portfolio. You need to make sure you understand what it is that you have in your portfolio. Don't focus so much on trying to make money in the stock market right now. Yes, go out, especially when it comes to small caps, for example. Small caps are a great way to make money right now because nobody liked them for a while, and now they're starting to become more and more important. Have you noticed? In my members get to see the stocks that I purchase, and you get to see exactly, the way small caps are behaving. And right now they're catching up. Why? Well, because as you're lowering rates in the stock market, it makes it easier for small cap stocks to rise because these companies rely heavily on interest rates. Interest rates go down, it's great for small caps, and that's what's happening. Plus, on top of that, everyone had been focusing on, the Nvidia, the Magnificent Seven. No, don't keep focusing on Magnificent Seven. What you want to do is you want to make sure, knowing that at some point the party is going to end. At some point the party is going to end. And you need to be aware of that. You need to make sure that you're protecting your portfolio. So how do you protect your portfolio? Well, it's very simple. First of all, what you want to do is when the market is going to pull back, you don't want to lose 50%. Maybe you just want to lose 20%. Okay? So you want to buy what no one is buying. And right now, no one is really buying small caps. But be careful. That is changing. More and more people are getting involved in small caps. You should look at 1929 because what happened in 1929? Well, at that time there was extreme speculation, frothy valuation on some of the stocks, and like in the late 20s, there are speculative excesses where many investors believe gain will continue indefinitely. You can't keep going higher. Leverage and debt, just as borrowing was rampant in the 20s with margin debt and speculative purchases, Spitznagel believes current credit condition and leverage are high. Rising interest expense on debt is one of the red flags. Now, of course, rate just went down, right? The Fed lowered the rates. That's correct. But as you're lowering the rates for the Fed has lowered the rates. That's because they are focusing more on what's going on with the employment. But you're not totally out of the woods with inflation, might I say so. Okay? You're not totally out of it. And that's probably why you want to make sure that you really understand what's happening. Right? For example, also there was policy missteps or suppressing correction. He believes that central intervention delay normal corrections, allowing risk to build up. That's also analogous now in 2029. But no, that's not true because the Fed lowered the rates. Well, that's the point. Maybe they should have not lowered the rates because inflation is not totally out of control. I will do a live as to what's going on with inflation. And you will realize that inflation is not totally out of the woods. A lot of the stocks, a lot of the companies out there, I don't know if you've been to Costco lately, but it's getting more and more expensive. So inflation might be coming back. So if that's the case, I don't think you should be lowering rates that much. And unfortunately, because the Fed is very polarized right now, the Fed is extremely polarized with what's going on. And I almost say the Fed is not even independent. I mean, the guy that joined, very Mirren, right? He joined the Fed the day before the rate setting. And what did he say? I want 50 basis points. Everybody was talking about 25 basis points. You know, I get reason. I mean, well, I'm not seeing any evidence of the inflation. No. Is he saying that because he really believed it or because Trump put him, gave him the job? And this is exactly what Spitznagel is talking about. Policy mistakes or suppressing correction. The central intervention delay normal corrections. That's analogous to what happened in 1929. Financial excess, weak regulation, and confidence mistakes contributed. You also had the investor psychology, euphoria, complacency, overconfidence. People assume nothing bad will happen, similar to what happened in 1929. So, we got this whole thing figured out about the tariffs, right? Right? So the idea is you got to be very careful, because if we lose track of inflation, and I did a video on that, on inflation and not being completely out of the woods yet. If that happens, then what you're going to have is you're going to have a situation where the Fed is going to have to raise the rates. You know what that's going to do? Now, is the Fed lowering the rates because they're being pressured? I think so. I mean, if you looked at the discussion being had with Powell, I mean, the idea is to say, well, you know what? Yes, there is a low unemployment. Okay, the economy is still strong, but we have low employment, so a little bit worrisome. But the economy is still strong. That means that the rate is being pushed up. The inflation is going to go up. And you say, well, the reason why we think there's going to be an offsetting situation is because there aren't that many people working. So that should offset what's going on with inflation. But one thing you need to realize is when we say this is happening and that is happening and we have so much inflation and so much CPI, the data is corrupted. The data is not accurate. We've seen it with the BLS situation, Bureau of Labor Statistics. 30% of the CPI is guesstimated. And the way they're collecting employment, frankly, is a bit questionable, because people are not replying to the survey. So we're really not seeing what we have. We're not so sure, who's working, who's not working. We're not so sure as to what is going on with inflation. So if you don't know what's going on with inflation, how could you make a decision? Well, you're making a decision because they want you to lower the rates. So you have two things happening at the same time. One, the data is inaccurate. That's not good. And two, there's pressures. Pressures from the government, lower the rates. And of course, when you're trying to figure out what's going on, it is very difficult to understand what is happening because the news is extremely biased one way or the other. Right? So you don't really know what's really happening. You will find out what's happening. When prices are going up and up, or people losing their jobs and jobs and jobs, then you're going to say, oh, now we have a situation. And then, of course, that's when everything unravels very quickly. So, of course, the assumption by Spitznagel, his argument depends on several assumptions, right? If they fail, the scenario might just materialize or could be delayed, right? So we may not have what we think we're having. One, debt servicing and rate pressures. If interest cost remains manageable and if inflation falls and rates stay low, the bubble may not burst or be less damaging. But is that a possibility? Do you really think that interest costs are going to remain manageable? Well, no, because if the the Supreme Court says that those tariffs are illegal, you're going to have to realize that if the tariffs are illegal, then you got to give the money back, which was going to impact the ability to pay for that $37 trillion in debt. Two, government central bank response. If authorities manage to intervene in smarter ways, gradual tightening, better regulation, that might cushion any crash. And that's what they're doing right now, which is good. They're being very gentle. Yield and valuation tolerance. Some markets may tolerate high valuation for longer. And of course, global external shocks, either accelerating or dampening factor, geopolitical, trade and commodities. Geopolitical. Let's talk about this for a second. What's going on with Russia right now? Trump yesterday said that he thinks that Ukraine should actually be winning. And we're going to help out. Russia has been, quote unquote, mistakenly gone into Poland. Denmark Estonia. Yeah, that's been happening. They're not invading those countries, but somehow their drones are getting lost or their planes are getting lost in those countries. And that's making a lot of people nervous. Poland is saying that next time you fly one of your Russian jets over Poland, I will shoot them down. Right? That's a geopolitical risk. So the market is doing great until it doesn't do great. And as I told you before about the elasticity hypothesis, yes, the market goes up, but it's inelastic. That means that when it comes back, that rubber band is going to hurt because it's going to crash that much faster. And right now it's being pushed just because the money is going into the market until it stopped going into the market when there's no liquidity. I was there in 2008. I remember what happened. So investor behavior, much of the scenario depends on collective psychology. If sentiment shifts earlier or risk is recognized sooner, this might moderate the crash. And my subscribers, don't forget to subscribe to this channel and to become a member as well. What this means is essentially, I think, the signal that you need to watch out for. The signal that you need to watch out for whether or not we're going to crash is as long as we're talking about it, as long as people are saying we're going to crash, the market is too high, we're going to have an AI bubble, don't worry about it. It's when they don't talk about it anymore and figure, you know what? Nothing bad is going to happen. That is when you need to worry about, because it's all a given. So his view is plausible and grounded in known risk factors, and obviously the guy knows what he's talking about. Now you have to understand how he makes his money. Billion, by the way. It's simple. They're not looking for the next NVIDIA. They are basically hedging for the risk that no one sees, which is basically what this channel is about. This channel is about black swan. We're looking for the black swan. We're looking for this animal that no one believes exists. In this case, we don't believe that the market is going to crash. We're going to think we're going to make money. We're going to be making money forever. That's not going to happen, right? And we need to see, well, when is it going to happen? We need to be prepared for it. So when is it going to happen, right? And the way he does it is they basically, and the fund is very, very interesting, because when you put money in that fund, you can't just take it out whenever you feel, right? He puts some money in the fund and he goes out and basically buys out long-dated hedges. Right now, you could buy a hedge, or you could buy a put on the S&P 500 that if it crashes next year, you could make money. Doesn't cost much money right now because nobody thinks it's going to happen. It's like insurance, basically. And that's what he does. He insures for the worst. Now, of course, you see, but how does he make money? Well, he probably loses money right now. Well, that doesn't make any sense. But listen. He made 4,000% in 2020, right? Is gold a hedge against an interest down? Yeah, well, that's the reason why, and that's worrisome, is that you're seeing gold going up and up and up and up, because, but that's more of an inflation, right? It's about inflation, and that's what you're doing with gold. You're offsetting gold, right? Because gold is very finite amount of material, and inflation basically is toned down because you can't make more gold. But dollars, you can make as many dollars as you want. And yes, but when we say gold, what does that mean? Let's invest in gold. Where do you want to go? You want to go to Costco and buy some gold? Because you could buy gold at Costco, believe it or not, but you can't sell it back to them, right? You need to find a way to be able to move in out of gold very quickly. Now, and the way we do it, and this is one of the stocks I recommended in my channel, and for my members, basically, when you're looking at it, it basically is a company that mines gold, but also does rare earth mineral. That's why it's up 75% for the past month. It's a great combination. But like we tell you, just because it's a gold stock, if the market retreats, everybody gets hurt. And this is the issue with the stock market, is that one stock impacts another stock. There's not independent events. It's like if you're playing a head tail with someone, right, with a coin, what is the likelihood you're going to win? You say, well, 50-50, obviously. No, that's not true. Statistically, yeah, you're going to, but in reality, no one has ever done 50-50 all the time. You don't say tail. When you spin that coin, right, you don't do a tail, and then you have a head, and then you have a tail, and then you have a head. You could have tail, 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 tail forever. Because the way you spin, the first one impacts the second one. And this is what's happening with the stock market. And that's why it's very complicated to understand the stock market, because one stock impacts another. These are not independent events. And if the events are not independent, it's very difficult to apply statistics. You cannot apply statistics because statistics almost assumes a normal distribution. Assumes that you're going to have lots of events in the middle, not too many events at right, and not too many events on the left. But here, what we're talking about, hold on, we are going to have an event on the left. We're going to have a fat tail, which means there's a possibility that something really bad is going to happen that no one is predicting. That is what you need to look for, because that's how you make money. And this is how Spitznagel made his money, 4,000%. So, you know what? Even if you make 4,000% 5 years ago, who cares? Right? You could afford to lose 10% every year, waiting for the 4,000, right? You don't have to make 20% every year. You could make 0 for 10 years and then 4,000% in 1 year. That makes it up completely. And that's what you need to do. And this is what I want my subscribers and my members to understand. So, his view is plausible and grounded in known risk factor. That's a fact. He understands what's happening. He realizes that this is what's going to happen. It's especially useful to emphasizing risk management and hedging rather than blind bullishness. That's what I want to do. Is Bitcoin going back to the insanely high during the downturn? It's possible. Bitcoin is the same thing as well. But Bitcoin is a bit like gold, right? It's an offsetting. It offset the inflation. But it's especially useful for emphasizing risk management, because this is what we're doing on this channel. I'm emphasizing risk management and learning. Maybe you learn something in the process, because you need to realize that this is going to be a lot of damage. That's going to be costly when it happens. However, historically, crashes like 29 are rare and result from a confluence of many bad factors. I am not saying, like everyone else, that the market is going to crash tomorrow. No, I'm saying that you need to prepare. You need to basically, think about all the things the bad things that could happen, so you could protect against it. When you're crossing the street, your primary goal is not to get across the street, hopefully, right? Because you don't close your eyes and cross the street. You obviously want to look right. You want to look left. And you say, okay, is it safe for me to cross that street? Then you cross the street. And this is to be the same thing with the stock market. But things to monitor, right? Things to monitor. What I would recommend is you monitor the following items to make sure that you know what's going on, right? So what you should monitor as these. Federal Reserve policy shift. How aggressive or delayed rate cuts or hikes are, What are they doing? Are they lowering rates? Why are they lowering rates? Are they lowering the rates because Trump wants them to lower the rates, or because they really want to do it? Right? Shouldn't they be focusing more on inflation? The levels of leverage across corporation and consumer. How much leverage is there in the system? Credit spreads and risk premia. How much extra yield investors demand for taking risks? So if spreads widen sharply, there is a warning. That all you need to do for this, you need to look at the 10-year yield. And right now the 10-year yield is around close to 4%. So that risk has diminished, which is good. Valuation matrix, like the price-earning ratio, the CAPI or whatever you want. P ratio right now is pretty high, right? Bitcoin feels like a cash grab, of course. A cash grab, yes. Valuation metrics, price earning multiples, sentiment indicators like mutual fund flows, margin debt, retail investors. I know it's a lot of things, right? You say, well, what the heck am I going to do with all these things? This is confusing. I mean, how do I want to make money. I don't want to, I don't want to think too hard. Well, I'm afraid to tell you, but you're going to have to think hard. You have no choice but to think hard. And the reason you need to do it, because that's how you make money. You need to understand what's going on in the world. And you need to realize that right now, you have a confluence of events. I mean, where's the market now, right now, right? Let's take a look at it. But basically, year to date, we're about 13%. Right? We're up 13%, which is not a lot, quite frankly, for the risk that we're taking right now. Right? But so think of it this way. Think about what's happening at the Fed. Think what's happening in the world, meaning geopolitical issues. That's very important because the geopolitical issues are a thing. Yeah, you want to make sure that you understand what is going on out there. So what I would recommend to my subscribers, and I would recommend to everyone, is make sure you follow what's going on with the Fed, one. Make sure you follow what's going on from a geopolitical perspective, two. And see what's happening in the stock market. And more importantly, what are you invested into? Make sure that whatever you buy, you've got yourself small caps, low P ratio, low debt, growth. I mean, you want all these things together, and that takes time because. But the most important thing, you don't want to be, FOMO, the fear of missing out. Because the thing, if you sit this one out, you're going to lose out. Right. So I'm watching my portfolio very carefully as it's going up, and making sure that whatever goes in there, unfortunately, because these are mostly mutual funds, you don't control that much. And this is the point that we made earlier with the inelasticity of the market, is that the market is going up, right? Because essentially money is going in the market to begin with. But $1 going into the market make it feel like $5 is going to be that's going into the market. And don't forget to subscribe to the channel, because I've got a couple of new sessions coming up, which should be quite interesting, because we're going to be talking about everything that has to do with, is the Fed truly independent or not?